Hi all, Lenny Hayes here of Trade All, and welcome to the weekly market update and outlook. Now, we touched base on Monday regarding a few key events that were coming up this week, and we gave a little bit of an insight into what we could expect to those things. And we saw a big move last night, with the first of those being the Jerome Powell testimony in the US Senate. We also had the Australian Reserve Bank announce another rate hike of 25 basis points, which did see a considerable market reaction across the currency and bond markets. And now we turn our attention to the job openings tonight out of the US, non-farm payroll numbers on Friday, as well as CPI and the Fed meeting in the coming weeks. So the big talking points out of last night especially was a very hawkish Fed. So Chair Powell pointed to rates rising even higher than previously thought, with the door open to even larger hikes in the coming meetings. So it's a real possibility that we could see a 50 point basis hike in the meeting, the March meeting, which is previously an increment from the 25 hike that we saw earlier. So rate expectations risen considerably off the back of that, as well as the USD, which was supported heavily. And on the other side of that, we've seen a pretty bad rout in the Aussie dollar and other currencies, but the Aussie especially, due to the divergence that we're starting to see between the RBA and the Fed outlooks. So it's weighed heavily on the Aussie dollar. The shift in thinking will probably keep the Aussie under pressure for the near term, just due to the stance of the respective central banks. We have seen the blow come out and touch on some things that he's flagged as being some flowing indicators in the economy, and that he's probably not as open to raising as aggressively as he has, and pause may be looming on the horizon. But let's get into Powell. That's been the driver of markets overnight. We've got his press conference here last night, so we'll just got a little bit of a snippet of that, and we can see what really went on. So a pretty hard-nosed central banker there. See the fears of the 1970s inflation crisis repeating itself is first and foremost for Jerome Powell. So he's going to do everything he can to avoid that sort of situation occurring. So now we look to the money market. We do touch on this every meeting, because the economic environment at the moment is all rates driven. It's a huge part of the economy, and especially in times of today where the rates are very volatile and very fluid. We're always keeping track of it. So let's look these short-term yields. Look at that, 5.2% for the 6 month and 5.19 for the 1 year. The 2-year government bond sitting above 5% too. So look, pretty bleak picture for bonds here. All of the short-term money market rates are pretty steep, and they've risen quite fiercely over the last week or two off the back of the Powell speech last night. They've extended their gains in yield even further. So look, the next attention will be these jobs. The jobs. We've got the double whammy of jobs. We've got jobs tonight and non-farm payrolls tomorrow. So Friday. So we're going to see how many jobs are available in the economy. Is the labour market still expanding? Is it still demanding more supply? Or and then we're going to see how the payrolls report marries up with the demand in the market. So very interesting. But as you would expect, the double dose of hawkishness last night cascaded markets. Saw US bonds rise massively, as we just touched on here. Terminal rate hiking, terminal rate pricing rocketed up to 5.6%. As you can see there, the futures market for the federal funds rate, very punchy, 9%. And by the end of next year, January next year, still be sitting at 5%. So you would expect pretty hefty sell-off across most markets overnight. When we look to 2-year yield here, that's just continued to trend upwards. It keeps surging ahead, closing above 5% on the session. A really bleak picture is this. This is the yield curve inversion. So this is a measure of the 2 and 10, which is the traditional method of measure. So that difference is now at minus 106 basis points. So that means that the 2-year yield is 106 basis points higher than the 10-year yield, which historically is always indicates recessionary environment and the recession. That it's been a pretty accurate indicator of it. And this is one of the deepest inversions we've seen and extended we've seen in a long time. Like if we turn our attention back, it's just continued to get deeper and deeper. It turned negative in June, and it's just been trending downward since then. So quite an ominous sign for the US economy. And look, equities, as you would expect, sold off. Futures contract for the S&P 500. It's just interesting to see how this breakout is tracking. It did bust out of trend in January, but over Feb it started to come down. Just going to be watching to see if it does close inside this trend here. It'll carry on with the long-term downward momentum that we've seen. So it'll need a break further down, but then we could see an acceleration to the downside. S&P 500, it was off about 1.5% last night. Well, that's from Monday, it's off 2.2%. So as you would expect there, quite a stark sell-off in equities across the world. Let's look at commodities. Copper, very good yardstick of global risk appetite in the world. It was off 2.2%. It's one of its biggest daily losses for the year. Same situation we saw with gold. On a long-term view, it has had a decent back end of 2022, rallying up quite high as a lot of assets did, but painting a similar picture to the rest of the market, has come off very, very heavily over February, and it was off again last night with that big gap downwards there. This is oil, so it's really struggled to gain much traction over any period. The oil market's becoming very hard to price and trade at the moment, just because of all the cyclical and macro factors at play. A lot of noise involved, and it's really it's a bit of a lottery as to what the price will do. A risk event like the Powell testimony did will obviously knock the price, but we've seen the likes of Trafigura, one of the biggest commodity traders in the world, come out and say that the oil price is behaving extremely erratically and almost not functioning truly. So that's where we're at now. $77 a barrel with factors of the war and OPEC intervention really causing havoc in the markets and creating a bit of a volatile environment. Look at the Hang Seng. It's had a pretty dismal month. It continued to fall. It's come off 2% since the start of the week. 2.7%, sorry. We can look at what it's been doing on a broader basis for our Chinese investors and viewers. We go there. So you can see it's that pivotal moment at the end of January. It's sort of started to come off again. So it is shaping up that sort of Christmas rally that we saw was a little bit of a, well, not yet to eventuate, but it is looking at a little bit of a false breakout. So look, as you can see, as we go across all these markets, whether it be equities and commodities, all following the same sort of trend. They're all following the same factors and cyclical forces and macro forces. So that's just where it's at now. Now let's turn and look at the RBA. So quite a stark contrast to the Fed and Jerome Powell. If we just take a little bit of time to read this, they decided to increase by 25 basis points, which was to be expected. So global inflation remains very high. In headline terms, it is moderating. Although service price inflation remains elevated in many economies, it will be some time before inflation is back to target rates. The outlook for the global economy remains subdued and below average growth expected this year and next. Monthly CPI indicator suggests that inflation has peaked. Goods price inflation is expected to moderate over the month ahead due to both global developments and softer demand in Australia. Service price inflation remains high with strong demand for some services over the summer. Rents are increasing at the fastest rate in some years, with vacancy rates low in many parts of the country. Central bank forecast is for inflation to decline this year and next to be around 3% by mid-2025. Medium-term inflation expectations remain well anchored. It is important that this remains the case. Growth in the Australian economy has slowed, GDP increasing by 0.5%. So left a few things to be desired and then a few eyebrows raised as to what the future may hold for future rate hikes. And the market saw this as Philip Lowe starting to tread carefully and maybe leaning towards pausing, signalling that he has seen a moderation in prices and economic growth, and therefore further and more aggressive rate hikes may not be warranted, as inflation has likely peaked, growth is slowing, and unemployment should start to rise. And we've seen the wage price index not increase too heavily, which eliminates the risk of a wage price spiral. That being said, the divergence between that rhetoric and the US Fed's rhetoric has caused the Australian dollar to drop massively, up from a high of 71.50 basically, all the way back down at 66 cents in a matter of just over a month or 2 months. That's a month. Yeah, so just in a matter of a month. So that's a big fall, and it just goes to show how volatile the Australian market is. And it's historically, the Aussie dollar is always at the forefront of these risk events, as it's historically been a security that most expresses investors' risk sentiment. So that it's a currency that traders and investors like to use, and it's historically very volatile in periods of high risk and high growth times. So that's where we stand there with the Aussie dollar ending down through here. It did break out over Christmas, but now back towards that downward trend momentum. So it's going to be we'll see if that can test new lows and break through back into the trend. But yeah, the Fibonacci levels are about, I think, down. If we could see some resistance down at the 68% mark, that's maybe 640 down here from the retracement of the high in Feb. This is the ASX. So yeah, we did see it base out, form some support here, and then rallied back higher. It's toppled back over here. It's now running to what could be support. May break through this and form a fresh downward trend. So it's going to be interesting what happens there. But it's going to be more linked to growth in America and how that economy pans out. It's going to be, the ASX will be helped by a more dovish central bank and RBA. So it had a decent day on Tuesday after the RBA was quite dovish it jumped up. But yeah, performance out on Wall Street is going to be a pretty good factor. It's going to be a pretty important factor for how the Australian share market tracks. Okay, guys, thanks once again for tuning in, and we'll touch base again at a later date. Thank you all.